Fair value gaps can add real value to your trading, but only if you know how to spot the ones you can actually trade. By the end of this video, you will know how to find a real fair value gap and ignore the fake ones, spot liquidity zones and understand why big players care about them, combine fair value gap and liquidity zones to create a strong trade setup, enter your trade on a lower time frame with clear signals. First, let us talk about what a fair value gap really is. You see a strong candle that moves sharply in one direction. This candle has a long body and almost no wicks. That tells you that the market moved very quickly. We call this candle 1. The next candle, which we call candle 2, opens at the close of candle 1. Then candle 3 appears. That area, between the high of candle 1 and the low of candle 3 in a bullish move, is called a fair bullish value gap. This gap shows an imbalance in the market. Why care about imbalances? Markets seek balance between buying and selling. When more buyers push price higher, an imbalance forms. Later, price often revisits that gap like a magnet, filling it before the uptrend continues, so the market can rebalance. We see the same idea in reverse for a bearish fair value gap. A sharp red candle drops, the next candle opens below its close, and the third candle leaves the gap between candle 1 low and candle 3 high. That gap shows a bearish imbalance, and price usually retraces up into it before the next leg down. If you look at a formation where candle 3 wick overlaps candle 1 wick with no empty space, you have no imbalance. In that case, the market was already balanced, and there's no fair value gap to trade. Gaps created by weak choppy moves, where the impulse candle lacks real strength, also tend to get filled right away. Likewise, once price has entered and closed within a gap, even briefly, that imbalance is considered neutralized and the gap loses its usefulness. Next, let us find liquidity zones. These are areas on the chart where lots of stop loss and pending orders are sitting. They often form at equal highs or equal lows, which traders call double tops and double bottoms. They also form at round price levels, like numbers that end in many zeros. Traders like to place stops just beyond those levels. Liquidity can also build up in tight consolidation ranges where price moved sideways for a while before breaking out. On your chart, draw these zones as horizontal rectangles in a different color than you used for fair value gaps. Maybe use yellow or orange. This will help you see them easily and keep them separate from your gap zones. Why do liquidity zones matter? Because big traders cannot fill large orders all at once without pushing price too far. They drive price into these zones to fill stop-loss orders or pending orders that smaller traders placed. Once they grab that liquidity, they reverse price back in the direction of the trend. By marking these zones, you are seeing where big traders will likely move the market before reversing it. This gives you an edge when you combine these zones with fair value gaps. Let's look at some trade examples. Buy trade setup. First, price creates a fair value gap after a strong bullish move on the 1-hour chart. As price retraces, it forms a small consolidation around this area. This tells us there's liquidity sitting just below those lows. Later, price sweeps that liquidity by moving below the double bottom and then continues into the fair value gap. Once price is inside the fair value gap, switch to a lower time frame like the 5-minute chart. Here, you're looking for entry confirmation, specifically a change of character. A change of character happens when price has been making lower highs and lower lows in a small downtrend, then suddenly breaks that pattern and forms a higher high. This shows that sellers are losing control and buyers are stepping in. When you see that higher high, enter a buy trade as soon as price breaks above it. Place your stop loss just below the fair value gap. For take profit, aim for the next major resistance level on the higher time frame. You can see how the trade plays out. Sell trade setup. First, price creates a fair value gap after a strong bearish move on the 4-hour chart. As price pulls back, it forms a small consolidation and creates a double top. This shows that liquidity is sitting above those highs. Later, price sweeps that liquidity by moving above the double top and then continues down into the fair value gap. While price is inside the fair value gap, switch to the 5-minute time frame. This is where you look for entry confirmation, like a change of character. A change of character happens when price has been forming higher highs and higher lows in a short-term uptrend, and then suddenly breaks that pattern by forming a lower low. This signals that buyers are losing strength and sellers are taking over. When you see that lower low, enter a sell trade as soon as price breaks below it. Place your stop loss just above the fair value gap. For your take profit, target the next major support level on the higher time frame. You can see how the trade plays out. Last trade setup. Again, we see a strong bullish move on the 4-hour chart, and price creates another fair value gap. During the retracement, price moves sideways and forms a double bottom. This builds up liquidity just beneath those lows. Soon after, price sweeps that liquidity by moving below the double bottom and continues into the fair value gap. As price sits inside the fair value gap, move down to the 15-minute chart and look for a change of character. This time, watch price in a small downtrend making lower highs and lower lows. When it suddenly forms a higher high, that's your confirmation. The sellers are weakening and buyers are coming in. When price breaks above that higher high, take your buy trade. Place your stop loss just below the fair value gap. For take profit, target the next key resistance level from the higher time frame. And that's how the trade plays out. Of course, no strategy works without proper risk management. Always risk only 1 or 2% of your trading account on any single trade. Before you enter, calculate your position size so that the distance from your entry to your stop loss equals that percentage of your account. If you have a larger account, you can risk a fixed dollar amount rather than a percentage, but keep it small so no single loss hurts you too much. Once your trade is live and price moves in your favor, consider taking partial profits when price is halfway to your target. Move your stop loss to break even on the remaining position so you protect your account from losses. Then you can trail your stop loss behind each new higher low on the 15-minute chart or below each new swing low on the 4-hour chart as price climbs. This way, you let profits run, but secure them along the way. If price suddenly reverses and closes back deeply into your confluence zone, you may choose to exit early to protect your gains. Finally, keep a trading journal. After you close each trade, write down where you marked your fair value gap and liquidity zone, which lower time frame signal you used, what extra filters you applied, your entry and exit rules, and the final outcome. Over time, you will see patterns in which setups perform best and which conditions lead to losses. Use that data to refine your plan and become a more consistent trader. To summarize, here are your steps. First, spot a valid fair value gap on the 4-hour chart and ignore the fake ones. Second, mark liquidity zones at equal highs, equal lows, round numbers, or consolidation areas. Third, look for overlap between your gap and liquidity zone for confluence. Fourth, drop to 15 or 5-minute charts for a clear entry signal like a structure break or a candlestick pattern. Fifth, add support lines, trend lines, and order blocks for extra confirmation. Sixth, manage your risk well, take partial profits, and trail your stop loss. Finally, journal every trade to learn and improve. Practice this method on a demo account until it feels natural. Watch how price reacts at these zones and refine your process. Over time, you will gain confidence and consistency in trading. Thank you for watching this simple guide on how fair value gaps can add real value to your trading.